Most people think the tax code is a bill. That is the first mistake. They open their return once a year, stare at the number at the bottom, and assume the system was built to answer one question: how much do I owe? That is how consumers look at it. Owners read it differently. Investors read it differently. Builders read it differently. When you spend enough years around capital, you discover something that sounds almost too blunt to be true. The tax code is not mainly a punishment manual. It is a map of incentives. It is the federal government telling the country, in thousands of pages of dry language, what it desperately wants built and what it is willing to reward. It wants housing. It wants energy. It wants equipment placed into service. It wants businesses capitalized. It wants domestic production, infrastructure, and long-lived assets that throw off output jobs and taxable activity for years after the first dollar goes in. And because the government cannot build enough of those things by itself, it does what large systems always do when they lack the hands to execute their own priorities. It bribes behavior. It says, in effect, if you direct capital toward the machine I need, I will treat you better than the man who simply earns, spends, and complains. That sentence alone explains more American wealth than most people ever learn. I have watched perfectly intelligent people spend their entire adult life on the wrong side of that divide. They work hard, they earn well, they save some, they pay what they are told, and every year they hand their tax return to an accountant the same way a patient hands an x-ray to a doctor, hoping the result is not too painful. They think the game is earning more. Very often the real game is converting who you are in the eyes of the code: consumer, employee, or owner. When I was younger, I thought that if you simply found excellent businesses and sat on them long enough, the tax problem would mostly take care of itself. There is truth in that. Great businesses cure a lot. But as I grew older, I learned a second lesson that matters just as much. You do not merely want a good asset. You want a good asset in a structure the tax code favors. That is where ordinary math becomes extraordinary math, because there is a world of difference between spending a dollar and deducting a dollar, and deploying a dollar into a favored asset where the system gives you accelerated recovery, credits, income, cash flow, and compounding on top of the thing you now own. Most people confuse those categories. They hear the phrase write-off and think that means free money. It does not. A write-off by itself is just a reduction in taxable income attached to money you already spent. It may be useful, it may be necessary, but it is not magic. If I spend $1 on something useless and save 37 cents in tax, I am still poorer than I was before. You do not build wealth by celebrating expense. You build wealth by acquiring productive assets under rules that let the after-tax economics improve faster than your cash outlay would suggest. That is a different thing entirely. The people who understand that difference stop living like subjects of the tax code and start behaving like operators inside it. They stop asking, how do I get a refund? They start asking, what does the government need badly enough that it will subsidize my risk? Those are not the same questions. And in 2026, that distinction matters more than most people realize, because the code is still doing what it has always done. It is still signaling priorities. It is still rewarding certain forms of capital formation. It is still telling you, if you are willing to listen, which side of the table it wants you on. Now, I need to make something clear before I go further. Whenever people hear this conversation, they split into two camps. One group gets excited too early and starts hallucinating easy money. The other group gets suspicious and assumes anything tax efficient must be shady. Both instincts are dangerous. The first produces greed. The second produces ignorance. Neither produces wealth. If you are going to use incentives intelligently, you need three things at the same time. You need a real asset, you need a real cash flow or long-term value case, independent of the tax treatment, and you need a structure that actually fits your return, your entity, your income type, and your time horizon. Remove any one of those and what looked intelligent starts turning into theater. I have seen people buy miserable real estate for the depreciation and then spend the next 5 years begging the property to justify its existence. I have seen people chase oil and gas shelters without understanding the operator risk, the depletion profile, or the difference between a story and a well. I have seen people install solar or buy equipment because they heard the word credit and never bothered to ask whether the economics still worked after financing costs, compliance, basis adjustments, recapture risk, and simple common sense. That is how amateurs get hurt. They hear incentive and forget asset quality. I prefer to reverse the order. First, I ask whether I would want to own the thing if the tax advantage were smaller than expected. Second, I ask whether the code meaningfully improves the return profile. Third, I ask whether I can hold the asset through a full cycle without needing a miracle. That sequence keeps you out of a lot of trouble because the code can reward discipline, but it does not rescue stupidity. The easiest way to see this clearly is to compare two people with the same income. Take one man who earns $500,000 as an employee and lives like a polished consumer. Nice house, nice car, plenty of comfort, money comes in, taxes come off the top, what remains funds the lifestyle, he may save some leftovers, he may invest a little through the usual retirement channels, but the machine sees him one way, income source first, capital allocator second. Now, take another person with the same income who begins deliberately moving capital into favored assets, not recklessly, not all at once, but intentionally equipment in a real operating business. Real estate in structures that actually fit the activity, energy, or infrastructure where the economics and the rules align. He is still paying taxes, he is still taking risk, but the system now interacts with him differently. One is feeding the machine, the other is being paid to help build it. That is why two households with similar earnings can end up in radically different places after 10 years. Not because one worked harder, because one learned to stand where the incentives are flowing. I like simple pictures. So here is the cleanest one I know. Most people earn, get taxed, and then invest what is left. A smaller group earns, invest into favored structures. Let's deductions, depreciation, or credits modify the tax outcome and then compounds from a bigger retained base. That second loop is not a trick. It is the entire point. The government does not reward you because it likes you. It rewards behavior it needs repeated at scale. Housing is one example, energy is another. Business equipment is another. Domestic productive capacity is another. Once you see that, the code stops feeling mysterious, it starts feeling embarrassingly honest. It is telling you what matters. The problem is that most people are reading only the bill, not the instruction. Now let me talk about the first category where this becomes obvious, productive equipment. The code has always been friendlier to people who place qualifying business property into service than to people who simply consume. There is a reason official guidance keeps revisiting first, year depreciation, Section 179, and the classification of business, use assets. The state wants equipment deployed. That is how output rises. You do not need a law degree to understand the underlying logic. If the nation wants more productive assets working today instead of 10 years from now, it will let owners recover cost faster. Faster cost recovery changes behavior. It moves purchases forward. It encourages build out. It rewards action. That is not politics. That is engineering. Now, the danger is that people hear faster cost recovery and immediately think, fine, I'll buy whatever qualifies. Number you buy what qualifies only if it also makes sense in your life and business. That means the asset itself must be useful, durable enough, and connected to a real economic engine. I do not care how generous the front-end deduction is if the back-end asset is dead weight. What I want is an asset I would be glad to own anyway, with a tax profile that turns a good decision into a better one. That is why the right investors obsess less over the phrase write-off and more over the phrase return on after-tax capital. That phrase sounds dry, but it is where fortunes hide. The second category is real estate, and this is where people get half the story and then damage themselves with the other half. Real estate is beloved because it combines multiple traits people understand intuitively: leverage, scarcity, cash flow, tax treatment, optionality. Human beings always need somewhere to live, sleep, work, store, or produce. That creates the foundation ordinary assets do not always have. But real estate is not magical because it is real estate. It is powerful because of the stack. Debt can magnify the equity return. Depreciation can improve after-tax cash flow. Rents can rise, land or location can appreciate. Inflation can erode the real burden of fixed rate debt. And if the property is chosen properly, all those forces can move together. That is the attraction. But again, people destroy themselves by hearing only one layer of the story. They buy garbage and call it strategy. They buy in the wrong market where land dominates building value and then wonder why the numbers disappoint. They assume a tax angle can compensate for a weak asset. They forget that the tax benefit is not the investment thesis. It is the amplifier. I have always preferred assets that would still deserve a place in my life even if the tax benefit were ordinary. That usually means something scarce, productive, or unusually hard to replicate. A property that can generate revenue, hold demand, and remain desirable without needing financial acrobatics. If the tax code helps me there, good. If the tax code is the only reason the property exists on paper, I am already suspicious. The third category is energy. Every serious government in the world understands that energy sits beneath almost every other economic promise it makes. Cheap, available, dependable energy is not a side issue. It is the bloodstream of industrial life. So incentives drift there again and again, whether through credit structures, deduction rules, preferred treatment of certain development costs, or direct industrial policy here. Again, the government is saying something plain. I need more of this built than I can build myself. If you want to help me solve that, I will treat your capital differently. That is why energy keeps reappearing in the code. That is why operators, financiers, and developers who understand the rules can shape astonishingly favorable economics. But energy is also where fantasy destroys people quickest, because the underlying projects are technical, cyclical, and operator dependent. You do not buy into energy because you heard the word incentive. You buy because you understand what is being produced, how it is sold, who runs it, how it is financed, how long it lasts, and what happens if the commodity cycle turns against you. That is not pessimism, that is adulthood. The fourth category is credits themselves. And this is where I want to slow down because most people misuse the word. A deduction reduces taxable income. A credit reduces tax itself. Those are not remotely equivalent. One is softer, one is sharper. And once people see a sharp instrument, they get overexcited and start reaching for opportunities they do not understand. I have learned to remain calm there. If a credit is attached to an asset that is too dependent on subsidy, I discount it. If a project dies the moment the policy winds change, I discount it. If the structure is so fragile that one rule revision turns projected brilliance into mediocrity, I discount it. I want the incentive to improve a sturdy bridge, not to serve as the bridge itself. That is why the best opportunities almost never look like lottery tickets. They look like strong assets or cash, yielding systems with an additional tailwind attached. The tax code should make good economics better. It should not be asked to resurrect bad economics. Now, there is one more layer to this that people rarely grasp until they have been around money a long time. The most powerful part is not the first tax benefit, it is the flywheel that begins after it. If your cash taxes are reduced because capital is directed into a productive asset, and the asset then throws off income, appreciation, or both, and you take that improved retained capital and redeploy it again into the next favored structure, the loop starts feeding itself. That is where life changes. Not in one transaction in the repetition. You stop living on a single stream and start creating a system where taxes, assets, and reinvestment begin interacting with one another. It is a compounding architecture. That architecture is boring to talk about at dinner, which is exactly why so few people build it. Most people still think wealth is primarily about getting a raise. It can help. But the bigger game is converting labor income into advantaged asset ownership before lifestyle inflation consumes the surplus. That is why I have never been impressed by people who boast about tax refunds or who brag about spending simply because a piece of it is deductible. That is teenager logic in a suit. The serious move is to ask a better question. What can I own that the government wants more of, that produces something useful, that I can understand, that I can finance prudently, that I can hold through a cycle, and that improves my position after tax without depending on fantasy? That is the question. If you ask it often enough, the path gets clearer. You begin seeing the same shapes again and again. A normal person sees a bill, an investor sees policy, a consumer sees expense, an owner sees basis, recovery, cash flow, leverage, timing, and optionality. A hurried taxpayer asks what to deduct. A patient allocator asks what to build. And once you cross that line mentally, you never really go back, because you start to understand the quiet insult built into ordinary financial advice. Most advice is designed to help people survive a system whose instruction manual they were never taught to read. Save a little, spend less, max. The standard accounts, hope markets cooperate, hope inflation is kind. Hope healthcare does not become vindictive. Hope the government takes only what you expected, that is survival. Ownership is different. Ownership says, I am going to learn what this system rewards and stand there deliberately, not illegally, not recklessly deliberately. That does not guarantee you riches. Nothing does. But it changes the odds in a way salaried consumers rarely appreciate until they are old enough to regret not having started earlier. I have often said that the first rule of wealth is not to confuse income with financial strength. There is a second rule that belongs beside it. Do not confuse paying taxes efficiently with avoiding your civic duty. Those are not moral opposites. The code exists as written. If the country wants houses, energy systems, equipment, productive enterprises, and investment, it is rational to respond to those incentives. You are not cheating the system by doing what it openly asked you to do. You are finally reading the manual the way it was meant to be read. Of course, that still leaves the hardest part, execution. Because once you understand this, the temptation is to overreach, to do too much, to imitate structures you do not understand, to leverage too far, to buy assets for the story, to hide bad judgment behind good tax treatment. I want you to resist that urge with your full strength. A mediocre asset with a tax tailwind is still a mediocre asset. A fragile deal with a shiny credit is still fragile. A heavily promoted opportunity that exists mainly to sell you the tax story is usually telling you something without meaning to. It is telling you the underlying economics are not attractive enough to stand on their own feet. Walk away from those. The right move is usually smaller and calmer. One asset class you truly understand, one structure you can explain to a bright 12-year-old, one deployment you would still respect 5 years from now, even if the tax benefit turned out less dramatic than advertised. That is how you stay alive long enough for the compounding to matter. I have never believed in building wealth from cleverness alone. I believe in systems that can survive your own emotions. This one can if you handle it correctly. The consumer path is simple: earn, get taxed, spend what remains. Hope the owner path is harder at the beginning because it demands learning, patience, and a willingness to look unexciting while everyone else chases consumption. But over time it becomes far more powerful because the code, the cash flow, and the asset base begin pulling in the same direction. That is when the government does not merely take from your effort. It starts helping underwrite your compounding. And when that happens year after year, the difference between two identical incomes becomes almost impossible to believe, unless you watched it happen yourself. That is why I no longer look at the tax code and ask what it will take from me. I look at it and ask what it is telling me to own. That question built far more of my wealth than any refund ever did. And if you are willing to ask it honestly with discipline instead of greed, it can change the direction of yours too. There is another reason this matters, and it has nothing to do with accounting. Identity hardens around money. A consumer measures success by what can be displayed. An owner measures success by what can be retained. One person gets a tax refund and thinks it is a gift. Another person reduces a tax bill and knows it was simply a better capital path. One household uses extra cash flow to upgrade the visible parts of life. Another uses extra cash flow to buy another productive asset and delays the applause. That difference looks small in a single year. By year 10, it is usually the entire story. I have seen people with beautiful visible lives and brittle balance sheets, nice address, fine clothes, excellent vacations. Nothing wrong with any of that. But underneath it all, the machine is weak. Too little productive ownership, too much dependence on earned income, too much tax friction, too little margin. I have also seen people who looked almost painfully ordinary while the internal math of their life was becoming unstoppable. They were buying equipment other people ignored, acquiring properties nobody wanted to brag about yet, funding productive systems in unfashionable corners of the economy, studying basis, studying debt terms, studying recovery schedules. Quiet work, invisible work, the kind of work that makes no sense to people who think wealth begins when other people notice it. The market often calls that boring. I call it durable, and durability matters because incentives are not static trophies. They change, credits phase down, guidance shifts, thresholds move, politics swings. If your whole plan depends on one line in 1 year of one code section, you do not own a strategy, you own a temporary coupon. But if you understand the deeper pattern, that government will continue rewarding the formation of assets it badly needs, then you stop chasing one-off gimmicks and start building adaptable judgment. That is the real edge, not memorizing every rule. Understanding what kinds of behavior rules tend to reward. Productive behavior asset. Building behavior risk accepted, where the state wants private capital to go first. Once you understand that pattern, you can adapt as the menu changes. That is how intelligent people stay ahead without becoming speculators in tax law. So if I were starting from scratch again, I would not begin by asking an accountant how to pay less. I would begin by asking myself 4 harder questions. What can I understand deeply enough to own without panic? What asset would I still respect if the tax tailwind were smaller than promised? What structure gives me both staying power and reinvestment capacity? And what part of my current tax bill is really a signal that I have remained too long on the consumer side of the code? Those questions lead somewhere useful. They push you out of the annual refund mindset and into a balance sheet mindset. And once you begin thinking that way, the line between taxes and investing stops being a line at all. It becomes one integrated system. That is when the game changes, not because you found a loophole, because you finally stopped playing the wrong role.